I'll do a quick recap of the basics of Social Security, and then we're going to jump into some of those advanced claiming strategies that I discussed last time, a couple of rules of thumb, and then I'm going to try to end the presentation by bringing it all together to put it in the context of your retirement plan, right? And why do we do it that way? Because the average retiree in the United States, 1/3 of their retirement income actually comes from Social Security. And it's a very valuable part of your retirement that I think a lot of people underestimate the actual value of it, not just from a taxation standpoint, but from a security standpoint. So let me jump right into it as we discussed last time. And then Vonnie, could you also give me a thumbs up if you are seeing my presentation here? So I'll make sure I'm sharing the right screen. Thank you. All right. So the premise last time, and again, I'm going to fly through the first 10, 15 minutes here. So if I'm speaking very quickly, there's an entire video over that Vonnie will put a link to that you can review this first part, and then I'll slow down as we get to the second part. So quick review. Here's the big problem. People are hurting their retirements by making very costly decisions about Social Security. They're trusting a friend, their CPA, their attorney, maybe a trusted, maybe even a financial advisor that is not well versed in Social Security. Maybe somebody at Fidelity. I don't know if they have an expert over there or not, but I see way too many people making very costly decisions for their retirement, not regarding Social Security and the value that it has. And I'm again going to reference a white paper from the Wharton School of Business from the Pension Research Council. It's called Rethinking Social Security in a 401k World. And it really developed my presentation on Social Security. And it's about 30, 35 pages, 40 pages long, if I recall. I would highly encourage you to take a look at it because it has some valuable information about the value of Social Security. And they have a lot of data points in there that I think are very valuable, that I'm going to try to communicate some of them here today, but not all of them, because I don't have enough time. So here are things to know about Social Security. First of all, lots of claiming options, lots of different times, especially if you're a couple, a lot of decisions that have far-reaching consequences affecting both spouses. Let's recall from last time, the system is not bankrupt nor a Ponzi scheme. Social Security will be there for you in retirement. All right, benefits do help family members, and you need to think of it in the context of a family decision, not a personal one. So what do you want to know? Social Security be there for me? As we discussed last time, it will, and we went over all the reasons why. You can review the other presentation for that. How much can I expect to receive based on your work history and when you apply? And then when should I apply for Social Security benefits? That's really what we're going to focus on today, and how you can maximize the benefits, right? So we talked about the trust fund last time. Balance is still at 2.7 trillion. As I said in the last presentation, is the first time that the expenditures actually exceeded income. So there was a net decrease in assets. We'll probably continue to see that as baby boomers roll through retirement. Without reform, benefits fall to 80% in 2034 because Vonnie and I will still be working, putting into the system, and immediately benefits get paid out. If there's not significant changes, then benefits will be reduced. Here are a couple of reform proposals. Again, review the other presentation if you'd like to go through those in depth. Bottom line, for the majority of people on this presentation, except for myself and Vanya, Social Security will not be affected, not likely to be affected by any reforms. All right. A couple things I mentioned last time that I think are really important to review. And Social Security is inflation protected income, meaning that you get a cost of living adjustment, whether you are taking your Social Security or not. And that cost of living adjustment is based off of CPIW, which is the Consumer Price Index for working individuals, which has trended hotter than regular CPI, which has been a good thing for beneficiaries. Just remember, if your benefit today is 2,000 and you live 30 years, or even 25 years in retirement, you're likely looking at over $1 million in benefits. So how much can you expect to receive? We discussed last time. Again, you can review that. We talked about the formula that goes into Social Security. That's not anything you need to memorize or understand because Social Security does that for you. We talked about claiming early and something called the actuarial reduction. If you claim before your full retirement age, your Social Security benefit will be reduced. And if you claim later than your full retirement age, your benefit will be significantly larger. Considering when to take Social Security should consider all these different factors that we discussed last time. and will be enough to live on retirement. I'm assuming most people on here have other sources of retirement, so I'm going to put it together in that context. If Social Security is your only retirement income, then obviously you need to take it as soon as possible. Very important to know your full retirement age. That is the date at which you will no longer be subject to what's called the earnings test, right? Where they can take away your Social Security if you have earned income, meaning 1099 or W-2 income. If you're born before 1954 before, it's 66, and then it stair steps up until 1960, and then you get to 67 after 1960. I would fully expect to see that number raised for the millennial generation as they work through Social Security reforms in the next 10 to 15 years. So if you apply for early benefits, and let's say your full retirement age is 67, you can see if you apply at 62, you're going to take a 30% cut in your benefit, right? If you go wait till 64, you take a 20% cut, so you only get 80%. If you wait to 67, you get your full retirement benefit. So what happens if you delay? Well, if your full retirement age is 67 again, right, you get 100% of your benefit at 67, and then you get what's called a delayed retirement credit each year after your full retirement age. So you not only get that 8% annual delayed retirement credit, right? So we call it the DRC. You also continue to accumulate the cost of living adjustment, which has averaged about 2.8 to 3% over the last 30 or 40 years. Here's how you go get your Social Security benefit and find out exactly what it is, ssa.gov. And then why would you delay? Again, we discussed how checks are going to be bigger down the road if you wait longer. You have the compounding of a much larger benefit, which in the long term helps you significantly more. So how can you maximize your benefits? Go look at your record. Is it accurate? Are you missing any years? Did an employer in the 80s or 90s maybe forget to report your income? If you have any zeros on there, it reduces your Social Security, so you want to make sure that you have an accurate record. And then, of course, applying at the optimal time. The other thing we discussed, and I think this is the last part we discussed, is taxation of benefits. This is the earnings test. $1 in benefits will be withheld for every two you earn over, somewhere around 23,000 in 2024. So be aware, if you claim early and you have earned income in the form of W-2 or 1099 income, potentially your Social Security benefit will not be given to you if you apply early. Once you hit your full retirement age, this is not the case. You can make up to $10 million a year and you'll get your full benefit. Taxation of benefits, I think, is probably one of the single most important things of understanding the benefit of Social Security. I'm going to make an assumption that most of you in this presentation have income because you're at UCSD or a spouse of somebody at UCSD over 44,000. And these numbers were created in 1983 under Social Security reform and not indexed for inflation, so they've remained the same. So married filing jointly, if your provisional income, which is simply your adjusted gross income plus 1/2 your Social Security benefit plus tax exempt interest, meaning municipal bond interest, is over 44,000, which I'm assuming is going to apply to almost everybody in here, if not everyone, then 85% of your Social Security is subject to ordinary income tax. That doesn't mean an 85% marginal rate. That means 15 cents on every dollar is not taxed at all. It's free, right? So only 85% of your Social Security benefit is taxed at your marginal rate, which is, let's call it 20, 25%, whatever. Top federal brackets, 35 for married filing joint. In the state of California, surprisingly, shockingly enough, does not tax Social Security. So it is worth significant, a dollar of Social Security is worth significantly more for you than a dollar from your 403b, 457 IRA, than a dollar from your pension, or a dollar from anything that's ordinary income. Okay, not from a Roth IRA, obviously, but any one of those other pre-tax, I don't call them investments because your pension is, I guess it's technically an investment, but all of those are ordinary income. Social Security, again, at the federal levels, 85 cents on the dollar at your marginal rate, and it is not taxed in the state of California. So for many of you, that's going to be anywhere from a 5 to 11, 12% savings on every dollar. We talked about some ways to minimize tax on Social Security. There's really not a lot of them other than having a Roth IRA or anticipating the RMDs, which we'll go through here in a second. Remember that Medicare will shrink your check, right? If you are claiming Social Security and over the age of 65, your Medicare check is, or your Medicare Part B premium is automatically removed from your Social Security. And as it says down at the bottom, you may be subject to the IRMA, income related monthly adjustment. If you want more information on that, please see the Medicare presentation for Monday. So remembering when we apply for Social Security, and just wrapping up what we discussed last time, if you apply early, your benefit starts lower and stays lower for life. The COLAs, the cost of living adjustments, magnify the impact of earlier delayed claiming and the compounding effect of that. Your benefit may be taxed and reduced to cover your Medicare premiums. It also may be removed from you if you are subject to the earnings test and you claim before your full retirement age. And remember that delaying benefits may give the surviving spouse more income. And we'll go over that here in a second. So number 3 here, and this is where we really get into advanced Social Security. For couples, you should always maximize the higher earner's benefit to protect a surviving spouse. Why is that? So that's a really good rule of thumb. If you are the higher earner, it doesn't matter if you're younger or older, but if you are the higher earner, I highly encourage you to go by the rule of thumb. You should wait until you're 70. There's always going to be extenuating circumstances for everyone out there. And if you have any specific questions to your specific situation, you can ask today or email me. But as a rule of thumb, the higher earning spouse, whether older or younger, should delay until 70 because they provide a survivor benefit to the surviving spouse if they pass away first. So what are spousal benefits? Spousal benefit is 1/2 the primary worker's primary insurance amount, which remember, that is the amount of your Social Security at full retirement age, if the spouse starts the spousal benefit at full retirement age. To give an example, John's PIA is 2,000, Jane's PIA is 800. If Jane applies at FRA, full retirement age, her benefit will actually be 1,000, not her 800 plus half of his. It just steps up to whatever is higher, her own benefit or the spousal benefit. Rules for the spousal benefit: the primary worker must have filed for benefits, so you can't take the spot. That you no longer can file and suspend, or all those tricks that were part of Social Security back prior to, I believe, 2016. The primary worker must have filed for benefits, and the spouse must be at least 62 for reduced benefit or full retirement age for full benefit. And there are no delayed retirement credits on spousal benefits. Now, what does that mean? If the spousal benefit is more than the spouse's benefit is going to be at 70, then there's no reason to delay taking the spousal benefit at full retirement age. So how do we coordinate them? So the maximization strategy, again, where a lower earning spouse's PIA, primary insurance amount, which is simply the benefit at full retirement age, is more than 50% of the higher earning spouse's PIA, both spouses would be recommended to wait until age 70. One spouse takes advantage of spousal benefits as allowed. That's something I actually need to pull out of the slide because I don't think anyone would qualify anymore for restricted benefits. And it maximizes lifetime benefits over average or long life expectancies. If you can delay, again, you may say, well, if I don't have that Social Security income, where do I get it from? And that's what I'm going to discuss at the end of the presentation. Hybrid strategy. This is where the lower earning spouse's PIA is less than 50% of the higher earning spouse's, right? So the lower earning spouse would claim early or maybe at full retirement age, just depending on how close they are in age. And the higher earning spouse claims at age 70. What this does is this generates income sooner while maximizing the higher earning spouse's benefit over both lifetimes. This is an example of a simulated custom analysis that we do. Again, this is free only to Maritime Retirement Association members. But what we do is we take all these different, basically take your full retirement ages, do a life expectancy, cost of living adjustment, and it prints us this nice report that gives us a good starting point for a recommendation on a claiming strategy. All right, I'm already widowed or divorced, so how does that impact my Social Security claiming? If you're widowed or divorced, you may be eligible for survivor benefits, which are very complex. Divorce benefits work very similar to spousal and or survivor benefits, and there's a couple qualifications we're going to go over. But let's talk about survivor benefits and exactly what they are and how they work. So survivor benefit depends on the age at which the deceased spouse originally claimed his benefit, his or her benefit, I guess I should say. So That's something obviously you can't control. They've already claimed the benefit, they pass away. If they claim before full retirement age, survivor benefit will be limited to the higher the deceased spouse's benefit, or 82.5% of his or her primary insurance amount. If claimed after full retirement age, the survivor benefit will include delayed credits. What does that mean? And some of you may be saying to yourself, this is really complicated, and I would agree. It took me several years to get this down. The survivor benefit, if claimed at full retirement age or later, will be 100% of whatever the deceased spouse is. That's really important. That's also why we always, not always, but traditionally recommend the higher earning spouse wait to 70 to claim, because they're providing a potential 100% benefit of their benefit to the surviving spouse. All right. And survivor benefit also depends on the age at which the widow claims. Survivor benefits, I'll just say this without reading this right to you, is that survivor benefits are incredibly complicated. There can be a strategy where you claim at 60, unlike spousal benefits, which can be claimed at 62. Survivor can be claimed at 60. Survivor benefit, it may benefit to start a survivor benefit at 60 and switch to your own at 70. It may be best to start your own at 62 and then switch to the survivor benefit at 66. There's all these different strategies within survivor benefit. If any of you are a widow out there, I would highly recommend that we talk about your specific situation separately, because survivor benefits are very complex and confusing. Just an example, Joe and Julie are married. Both are over full retirement age. Joe's benefit is $2,000 and Julie's is $1,200. Joe passes away and Julie notifies Social Security, and her $1,200 benefit is reverts to his benefit, not hers plus his survivor benefit, but to his maximum benefit. This requires both of them over full retirement age. Delayed claiming, Joe and Julie are married. Joe's PI is $2,000. He files at 70. His benefit is he gets the delayed retirement credits, so an extra 32%, but it would actually be more because of the cost of living adjustment. This is just an example. He passes away, and Joe or Julie's survivor benefit, if she claims at full retirement age or later, would be 100% of his. If prior, it gets into a really messy, confusing formula that, again, if you are subject to a survivor benefit, please contact me offline. Just some basic rules on survivor benefits. The couple must have been married at least 9 months at the date of death, except for in the case of some type of traumatic accident. Survivor must be 60 or 50 if disabled. Survivor benefits are not available if the widower remarries, right? If they remarry before age 60 and they are not taking their survivor benefit and they remarry, they're not eligible for that survivor benefit. And divorce spouse survivor benefits are available if the marriage lasted 10 years or longer. Same thing with divorce spousal benefits. Same as the spousal benefit. Like I said, divorce spouse, marriage lasted 10 years or more. The person receiving divorce spouse benefit is currently unmarried. The ex-spouse is at least 62. And if the divorce was more than 2 years ago, the ex-spouse does not have to have claimed benefits. What does this mean? Just to kind of give you context, I forget how many times he's married. Johnny Carson, I believe, was married 3 or 4 times. And the whole story is that every one of his ex-spouses, because he was married more than 10 years, I believe, to each one of them, the spouses both claimed his spousal benefit and survivor benefit when he passed away, and none of them knew what the benefits were. The Social Security Administration does not notify, if you are divorced, does not notify your ex-spouse if you are claiming off of their record. They will have no knowledge of it whatsoever. So again, if you have questions about divorce benefits, please let me know, and I'll be happy to go over those on an individual basis as well. A couple of rules for divorced spouse benefits. Just as I said, more than one ex-spouse can receive the benefits on the same worker's record. Benefits paid to an ex-spouse do not affect those paid to the worker, the current spouse, or other spouses. And they stop upon remarriage of the divorced spouse that is taking the benefit, but not upon. So if your ex-spouse goes and marries someone else, then that doesn't cut your benefit off, only if you remarry. Gee, this is really complicated. Yes, it is. There's a lot of facets to Social Security. Again, it took me several years to really nail it down. And I have to admit, that sometimes I still have to go back to the books and make sure I read it to make sure I have it correctly. So again, in life, would you rather be early or delayed, pay a penalty, or get a bonus? and make sure you are maximizing your Social Security. I gave you a couple rules of thumb in this presentation. Okay. And now I'm going to go over kind of the crux of what that paper would, the rethinking Social Security in the 401k world. So let me do a new share here. All right. First, let me stop and ask if there are any questions, because now we're going to get into basically the value of Social Security and why I think it's so important to delay taking Social Security. Any questions out there, please unmute yourself or type it in the chat.
Oh, I have a question.
Yes, please fire away.
Yeah, I'm still a little bit confused if my spouse takes Social Security at 70, because according to your advice, and then he dies, and I'm over 65. You're saying that I can claim 100% of his Social Security at the time that he, like 70, right? At 70 years of age, not 50%, because I always thought it's 50%.
50% for spousal,
Oh,
that's
spousal.
spousal benefits. And survivor, it's 100% if you claim at your full retirement age or later. So
So,
let's say your full retirement age is 66 and 10 months. Your husband waited to 70, let's say passes away at 73, 74. You are eligible for 100% of his benefit at your full retirement age or later.
so do I get both the spousal and the survivor, or just one of them?
No, you get the higher of the two.
Okay, got it. Thank you.
Absolutely. Good question. So let's just here, and pardon my drawing, I'm not an artist, but let's just simplify retirement and say that this is your mailbox money. This is your monthly money that comes in that you use to pay your bills and be retired and all those things. So what are some sources of income in retirement? Well, most of you are UCSD folks. So you have your pension, right? I'm just going to put a title here of IRA. Again, sorry for my writing. I'm writing it on the screen. Your IRA, which remember IRA, and I'm saying traditional IRA, not Roth IRA, could be, rollover from your 403B, 457, DCP, all those different things. Okay. Social Security. And maybe I'm just going to put a T here for trust, or, maybe it's an investment account or whatever. So that pension that you have, right? When you take money out of the pension, right, you pay ordinary income taxes at both the Fed level and at California, right? So every dollar that comes out of this pension or this IRA, because they're one and the same essentially, you're paying, paying ordinary income taxes, meaning every dollar comes out, you pay tax in the state of California, you pay federal taxes. Okay, if you have this trust account, maybe it's after tax, and you have some dividends, maybe you have some municipal bond interest, but more likely than not, you're going to pay California taxes at ordinary income, and maybe you have a special rate at the federal level dividend, but you're still paying significant amount of taxes. And remember, California does not have any preferential, capital gains. No, it's all ordinary income in California. But Social Security, remember, it's only 85 cents on the dollar at the federal level. And in California, it's not taxed at all. And that's what makes Social Security worth so much more than all these other sources of retirement income. Now, if you delay Social Security, remember from 67 to 70, okay, you get an 8% delayed retirement credit each year, plus cost of living adjustment. Let's just call that 3%. Okay, that's 11% fully tax deferred rate of return on your Social Security benefit. That is a pension guaranteed by the full faith and credit of the United States government. 340 million of us taxpayers are backstopping that. This pension over here is backstopped by the 45 million people that live in California. Who would you rather have backing your pension? 340 million taxpayers, right? Or 40 million taxpayers? I'm going to go with Social Security, right? The federal government's the only thing I know of that has unlimited spending power. And it's also, one of the two biggest social benefits that we have in this country. In addition, what happens as we get older? We get more conservative, not from a standpoint of politically, but we become less risk tolerant. I guess that's probably a better way to say it. Okay, so we want less volatility in our portfolio, in our investments. So every time you take a dollar out of your IRA, let's say it's during this time period from 67 to 70, and instead of claiming, at full retirement age, let's say a $3,000 benefit, you just take 3,000 a month out of your IRA. You are effectively trading an IRA dollar that's taxed at ordinary income in the state of California and ordinary income at the federal, and growing a dollar of Social Security or exchanging it for a dollar of Social Security. Why is that important? One of them is a guarantee by the federal government. The other one, your IRA 403B 457, I don't care who you work with, what your advisor is, whatever. There are fees and expenses associated with that IRA 403B 457. At Fidelity, does Fidelity help you administer your 403B and 457 for free? No. There are expense ratios. There's, if you roll to an IRA and you go in one of their advisory programs, there's an advisor cost and expense ratios, trading costs. And that IRA has volatility, has market volatility. I mean, you could tell me, oh, it's all in bonds. And I say, well, what happened in 2022? Put it all in treasuries. What if treasuries are only paying short-term treasuries are paying great right now? They're paying what, 5.25%? But they're not paying 8% guaranteed, and they don't come with a COLA. And so by switching a dollar of your IRA, meaning drawing down your IRA during this time frame, all right, from the time of your full retirement age or your retirement to the time you're 70, you're effectively exchanging an IRA dollar for a Social Security dollar. And what's the expense ratio for Social Security to put that deposit in your bank account every month? 0. What's the advisory fee that you pay? 0. What's the volatility of that Social Security? 0. So you are effectively taking a risk dollar that has a cost to it and exchanging that for a guaranteed dollar in your future retirement, and not just for yourself, but potentially for your spouse, just as the woman just asked the question, for their lifetime, right? And so that's the premise of rethinking Social Security in a 401k world, is that a Social Security dollar is worth significantly more than anything that comes out of a 401k, IRA, 403B, 457, or a pension. And with that, I hope that kind of puts it into context why I think Social Security has such a underappreciated value when you're going into retirement. So with that, we're 30 minutes in, and that's pretty much the presentation. I've got a real messy whiteboard up there for all of you. Does anyone have any questions regarding the strategy? Let's see, it has something in the chat there. Chris Wright says, instead of taking an IRA dollar during 67 to 70 and don't need that dollar, what would be the advantage of putting that into a Roth IRA instead? Chris, I don't know in California if there is an advantage. It's going to be based off of each person's income brackets. Again, my problem with Roth IRA conversions later in life is, how do you make up the difference of what you lose in the tax that you pay converting to a Roth IRA? I know it's popular for people in my industry to say, oh, consider a Roth conversion, yada, yada, yada. But the problem is, we all live in California, and it's the most progressively taxed state in the union. And what I mean by that is lower incomes pay a significant penalty. So if you're moving, let's say 50,000 from an IRA over to a Roth IRA, that's 50,000 in incremental income. And if your income's already, let's say 100,000, that now puts you at 150,000, which federally is going to be in the mid 20s for tax bracket, and California is going to be at 9. And so it's going to cost you over 33 or 1/3 of that 50,000 in taxes. And if we go down 33%, we need 50% just to get back to even in the Roth IRA. And this is at a time when most people are later in their life, in their late 60s, early 70s. And I just don't agree with the logic on it, because I think there's too much of a tax penalty. I hope that answered your question, Chris. Thank you for that question. So please feel free to unmute yourself, or you can type in the chat if you prefer. I know it's a Social Security is a lot more complex, I think, than people give it credit for. So are you saying take the money from pension and retirement accounts and not take Social Security, so increase Social Security future payments? That is exactly what I am saying, Karen. That is exactly what I'm saying. By doing that, again, by trading an earlier IRA or pension dollar and exchanging it for a latter Social Security dollar, you're taking risk out of your future portfolio. You're increasing the tax efficiency of your retirement distributions, and you're putting more reliance on a guaranteed pension in your future life than you are on investments that come with fees and expenses and volatility and everything else. So yes, Karen, that's exactly what I'm saying. Mary Cliff says to the group, can you discuss RMD and withdrawing money for rollover IRA? So Secure Act 2.0 changed the required minimum distribution from 70 and a half to a couple different ages, 72, 73, and 75, dependent on what your age is now. You can write me offline if you have any questions specific to your situation. But each year, let's just say, and I'm just going to say for a round number, you have $1 million in your IRA, which is a rollover from 403B, 457, et cetera, and you roll it over into an IRA, you can expect your RMD. It is a function of IRS life expectancy tables, and it's the balance on December 31 of the previous year multiplied by that factor, and that is what your RMD is for that year. And it's just a required minimum distribution. The IRS says you've tax deferred this income for 20, 30, 40 years, you have to start paying the taxes out. And that amount goes up each and every year. And that amount is calculated by wherever your IRA is held. So whatever brokerage house, Fidelity, if you're with us, Wells Fargo Clearing Services, we calculate that for the clients and then let them know right away in the beginning of the year. Should we withdraw more before the RMD age? Well, again, that's the premise of this strategy is you draw down whatever your Social Security payment was going to be. If that was part of your thought in retirement income, is to draw down that amount out of your IRA instead of Social Security and delay the Social Security so that it maximizes and you get that 8% plus the cost of living adjustment. So a common argument is, well, why don't I get my Social Security payment and then invest that instead of delaying Social Security? And my response would be, well, if you get your Social Security benefit, you're getting taxed on it on the front side. You put it in an investment account, you're going to get taxed on your investment gains at ordinary income in California and whatever the federal rate is based on the investments, right? And there's no guarantee. Whereas Social Security is going to give you full tax deferral and 8% guaranteed. And if you add the cost of living adjustment, just the average over the last 30, 40 years at 3%, that's an 11% rate of return, net of fees, expenses, because there are none in Social Security. So if you can find an advisor out there that says to you, I can beat 11% guaranteed, including my fees and expenses, first of all, they're lying to you. Second of all, the amount of risk that they would have to take to get that return would be astronomical for someone in their late 60s, early 70s. I would rather, and the advice that we give our clients is no, draw down those retirement accounts, delay the Social Security. I don't think this is for nefarious reasons, but unfortunately, I don't think you get a lot of that advice in our industry. Maybe it's because, people are getting paid on the size of the big, RMD, IRA, whatever it happens to be, not RMD, excuse me, IRA or 403B, whatever. But I'm a big proponent of it because I think it really does the right thing for retirees, especially once they begin taking those checks at 70. So does anyone else, I see you're all still here. So anyone
I
else?
have a question. Can
Yeah,
you hear me,
Marlene, please
Brian?
go ahead.
I apologize. I'm traveling and I'm in a car trying to watch this on a little tiny screen. So could you possibly just go over one more time the reduction in benefits that you would have if you go early and you have other income? You said if you have either 1099 or W-2 income,
That's
you would
correct.
get this reduction. And I'm assuming the 1099 income would include pension income, of course. Could you just go over that one more
No,
time?
pension income is not considered part of that. Pension income is, when I mean 1099, I mean independent contractor income.
Okay.
Yeah.
Very
So
important.
pension
Okay, thank
income
you.
is not earned income, it's unearned income, right?
Got it. Okay, perfect.
Technically, it is earned because you earned a pension over your lifetime, right?
Right.
But it's not considered from a tax standpoint as earned income. The
So
earnings
that would not affect the dollar for every $2 calculate or computation you mentioned of
you are
loss.
correct. You are
Okay,
correct.
good. Thank you.
Neither
That
would
would
IRA distributions, dividends, all that stuff. That's correct.
perfect. Thank you. Okay.
Absolutely. But again, I want to be clear, I wouldn't recommend taking it early unless there is a reason to. And going back to those two rules of thumb, one of them was if the lower earning spouses primary insurance amount is less than 50% of the higher earning spouse, then there's a case to be made to take it early and not delay to 70. I would encourage you to get an analysis done by us, because that's a big decision. And so
Got
just so
it.
you know, like when we run these analysis, like I've run analysis where two couples claiming at 62 versus 70 ends up being $1 million of difference in Social Security benefits if they live to their early mid 90s. So there is a huge range of potential benefit that you get from Social Security that I think can be mistakenly left on the table if you're not keenly aware of exactly what the best optimization strategy is for you. All right, I have another one here in the chat. Oh, thank you for the info. You're welcome, Ellen. Thank you. And again, you can always review this. Vanya, I'm sure you'll have this posted to the YouTube channel. And if you have any specific questions, I'm just type my email address here in the box. You're more than welcome to reach out. I'm happy to answer your questions as I get them. And if there are no more questions, then thank you everyone for joining us today, and happy Thursday, and we'll see you next time.